Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone. Welcome to the Millionaire Next Door podcast. We're so pleased you're here for conversations that matter. I think this is going to be an excellent one. We're joined today by a terrific guest. Actually, this is his third time, so we really appreciate his time and his expertise. Phil Huber. And Phil is the managing director and head of portfolio solutions at Cliffwater. He's also the author of The Allocator's Edge. So Phil writes a lot and does a lot of deep thinking about investment management, particularly in the alternative investment space. So we're thrilled to have Phil join us today. So thanks, Phil.
It's great to be back here for the third time, Robert. Hopefully that's a good signal that our prior conversations have gone well, that you keep asking me back.
Oh, absolutely. Yeah, I think you've been really helpful from a big picture perspective. And one of the things we were chatting about, I know at Cliffwater, and you've done a lot of work creating some sort of custom indexes. For example, the Cliffwater Evergreen Private Equity Index. And you've written a paper, the Evergreen Private Equity for the Long Run. Just curious, maybe we can launch into some of that in a big picture sense. Why does private equity matter? And what is private equity or what has made it one of the most effective long-term wealth builders historically?
Sure. Yeah, we'll start just the premise of the index and why we created it. We have a few different aspects to our business at Cliffwater. We started initially 20 plus years ago as a consultant to large institutions on how to allocate their capital in alternative investments. Subsequently, in the late 2010s, we became an asset manager and began managing a series of interval funds for private wealth clients. And then, but probably less known amongst people out there, is that we have an index business as well. So we recently, just a couple of weeks ago, launched a private equity index, which we'll speak more to in a moment. But we've been in the index business going back to 2015 when we created what's called the CDLI, which stands for Cliffwater Direct Lending Index. So that's been kind of part of our DNA. We're a very research-centric organization. And I think also, too, when we recognize a growing area or opportunity set, particularly in the private market world, we think it's important for investors and allocators to have an appropriate benchmark or some series of data that can help them better understand the risk and return characteristics of particular segments of the market. And so we did that with direct lending in 2015. And then this year we're doing it within private equity. But it's a little bit different in terms of the type of private equity solutions that we're indexing here. So what's been one of the prevailing trends in the past, call it 5 years, has been really the emergence and widespread adoption of what we call evergreen private equity funds, particularly among individual investors and financial advisors. That's a bit different than the what we'll call traditional approach to private equity that many institutions have employed for the past 4 decades or so. So taking a step back, it's important to maybe start with the big picture, kind of why private equity to begin with. Why is there such interest in the asset class? And a couple of reasons. One is it's historically delivered. We do an annual study of the performance of private equity portfolios of public state pensions, because it's all publicly available data. And what that data set has shown us now over 20 plus years has been that the net of fee returns of pension private equity portfolios has delivered about a 400 basis point or 4% outperformance relative to a mix of global public equities. So certainly kind of capturing that private market premium, if you will. Importantly, too, on a rolling 5-year basis in our data set, we've shown that private equity has beaten public equities more than 90% of the time. So it's really demonstrated itself now over many decades as a really effective long-term asset class for compounding wealth. The challenge historically has been how can we translate this powerful asset class to a broader audience, not just the pensions and endowments of the world, but the individual investors that are trying to build diversified portfolios. And that's historically been a bit of a hurdle for a lot of reasons. One is the high minimums involved typically in what we'll call traditional drawdown funds, which I can explain what that means in a moment, but also the really long illiquidity and lockups involved, the dealing with just kind of the operational pain points of capital calls and lots of paperwork and things of that nature. So for a variety of reasons, most individuals have been kind of shielded from this asset class, but that dynamic's really been changing the last 5 to 10 years, and we're really excited about that.
I'm excited about it too. I don't really want to deal with those capital calls or complicated tax structures or things that string out your tax reporting. They just complicate life, and the fact that you can make them a lot simpler and the evolution of that is just wonderful. I got to personally share. So I appreciate it. And then, by the way, the work on the indexes that you've done is terrific. Now, I've often followed Cliffwater, and you'll do these reviews quarterly of indexes and how they've done over time. Your chairman, Steve Nesbitt, presented one down in Newport Beach a few months back.
Mm-hmm.
I'm in this space all the time, but it's so helpful to see from a sort of a big 40,000 foot view, where the risk, the reward, and where that upside is. You guys are sort of like a repository for just massive amounts of data, especially on the direct lending side and now on the private equity. So it's really good, even if you're deep into the space and the differentiation, just to step back and see it and have it updated. So that's been super helpful for me. I don't want to break up your flow there, but I can share that with folks. I've shared that with a lot of clients and folks who are interested, but please continue on. I just want to let you know I found that even though it's basic in the big picture, there's a lot of detail, and it paints a very meaningful picture of why one would want to be exposed to those areas.
Great. Yeah. So maybe going back to the differences in structures. So I mentioned the term drawdown fund before. That's been the predominant way of obtaining access to private equity historically. These are typically, call it closed-end limited partnership type vehicles where you have to be what's called a qualified purchaser. So at least $5 million of net worth just to be eligible to invest. You have a finite fund lifespan, often in the neighborhood of 10 to 15 years. And it's an episodic fundraising. So these are funds that are not always in market. They'll raise a fund, they'll invest it, and then a few years later come back and raise another fund, et cetera. And so that doesn't make for the most seamless investor experience. A lot of complications, both operational and investment too, in the sense that when you're committing to one of these drawdown funds, your capital commitment, they're not taking all of your money immediately and deploying it into companies. That process takes place over several years, maybe 3 to 5 years. And so you as the investor are then responsible for, okay, what do I do with this committed capital that I've offered this manager that I need to figure out how to invest it or preserve it until it gets called. And so it just adds another layer of complexity. By contrast, evergreen funds, and as the name kind of implies, evergreen, these are designed to be perpetual in nature. So there is no sort of finite lifespan where it gets wound down after 10, 12 years or so. The investor eligibility is much more broad. Most of the products in the market today that are structured as evergreen funds are either available to accredited investors, which is a lower threshold than qualified purchaser, or increasingly we're seeing a lot that have no accreditation requirement whatsoever, and that's largely due to recent updated guidance from the SEC. Subscriptions often come in the form of you can either come in daily or on a monthly basis. More often, we're seeing funds that are letting folks in through just ticker symbol trade execution, much like you would upload a mutual fund or ETF, trade to Schwab or Fidelity or whichever custodian. So kind of bypassing some of the more just, I guess, onerous or just annoying filling out of subscription documents and paperwork, et cetera. And importantly, it kind of fits more seamlessly into a broader investor portfolio that includes public assets, where it allows for more frequent rebalancing and more frequent valuation updates, lower minimums for trading, et cetera, 1099 tax reporting. So it just it's an easier, pivot for those that are newer to private markets. where the experience as an investor outside of the liquidity is much like they've experienced with their public portfolio. Now, the liquidity piece is important because anytime you're trying to combine, a illiquid asset class with a structure around it that offers periodic liquidity, that liquidity needs to be managed thoughtfully. But we've seen, that there are certainly best practices where that can be done successfully. And I think importantly, when I mentioned the capital commitment process for drawdown funds earlier, that takes several years. One of the main benefits in our view of evergreen funds is that you start to compound your capital quicker because you're stepping into a pretty fully invested, diversified portfolio immediately, as opposed to that taking place over several years. So certain structural benefits. What we tend to see sometimes, anytime there's a emerging vehicle type that offers to democratize investing to a certain area, I think certain folks' antennas go up and they start to naturally have some degree of skepticism, which is okay. We've seen this historical benefits of private equity. If you translate that to a more investor-friendly or democratized vehicle, is all of that benefit going to get lost in translation? In other words, for the benefit of the convenience, are you just going to sacrifice quality or pay more in costs? And it's a valid concern that people have, but I think we're seeing a lot of great innovation in the structure of these funds that will, I think, hopefully retain a lot of the benefits of the private equity asset class. And I think we also don't have to look further than a lot of common examples in our everyday lives where investors are able to obtain greater or similar quality while also getting more convenient or improving in cost over time. Examples like Netflix, Uber, Spotify, just to name a few. So we think in the investment world, private markets are going to kind of follow that continuum as well, and just again, be able to improve the investor experience while retaining the asset class benefits.
Yeah, that's all really, really helpful. And I love that you addressed that you don't really lose anything in translation, that the industry has worked through that. That's great to hear. And the democratization, part of it is just if multimillionaires, can access it, but quote the millionaire next door, or it's just nice that that's more accessible and not excluded from the huge chunk of society.
Yeah, and I think that's a good segue into the index and why we created it, which was to sort of try to answer that question, which is we've seen a lot of growth in these evergreen structures, and these evergreen structures are really the audience for those is financial advisors and their end clients. So now we have a data set to actually go say, okay, I mentioned earlier that pension study we do that showed about 4% annualized outperformance over public markets. The question is, have these evergreen funds, now that we have a large enough sample size and a little bit of performance history, are they delivering that same promise to investors? And so in terms of the makeup of the index, it starts back at the end of 2009. Importantly, though, we're starting with one fund. So this is relative to, say, something like the S&P 500, which is an index of companies or stocks. Our index, which is called the Cliffwater Evergreen Private Equity Index, or CEPEI for short, it's an index of funds. And so importantly, the returns are net of all fees of these funds. The index is asset weighted, meaning the larger funds in the category represent a larger piece. And that's not because we're implying that they're better funds. It's just more relative to an equal weight approach. The asset weight is more reflective of how investor dollars have actually been allocated in the space. We also have certain eligibility requirements. We require funds to have at least monthly performance data. We require them to have at least $100 million of AUM to be included, but there's a handful of other criteria as well. But that's kind of how we arrive at what gets included. At the end of 2009, you have to start somewhere. So at the end of 2009, there was one fund in the market, and it kind of remained one fund for the next handful of years. And so this wasn't like a big category back in the early 2010s. It was kind of in its infancy. And what we saw was kind of around the end of the 2010s, 2019, 2020 was a lot more product come to market, a lot more innovation. And today where that sits is there's in our index about roughly 30 funds that represent about 65 billion of net assets. So it's become quite sizable. But importantly, when you look at the return history of the index, it's delivered about 2%, a little over 2% return premium above the MSCI ACWI index, which is a representation of global stocks. Obviously, that's smaller than the 4% that I mentioned earlier on the institutional side with the pension study. But I think back to the comment earlier about the sample size is that data set is largely influenced for many of those years by one or a small handful of funds. And so I think it's one of those situations where the index over time, as the space continues to mature and new entrants get added, the performance track record continues to elongate. The data set will be more and more illustrative of what's actually happening there. But we're certainly encouraged by the initial results that the index showed. Importantly, is that if you look within those 29 constituents of the index, there's a massive amount of dispersion, which really highlights the importance. If you're an advisor looking at these funds, which fund that you select to get your clients, exposure is going to largely be the difference between, success and failure. And just to use an example, over the last 3 years ending June 30th of 2025, the median return for this sample of funds was about 10%. The best performing of those 29 delivered 21% annualized returns, whereas the worst performing in the index was essentially flat for that 3-year period. So just kind of illustrates the massive dispersion and the importance of due diligence and manager selection and actually capturing that private equity return stream. So in the paper, we also try to highlight what are some of the best practices in Cliffwater's view for really generating long-term success in Evergreen Private Equity. And I'll kind of list those out. And if you want, Robert, we can dive into any or all those in a more deep level. But really the 5 areas of focus for us are liquidity and liability management, valuation integrity, fee efficiency, platform focus, and balanced portfolio construction. So I'll pause there.
Yeah, that's great to get all this data. And then, you can see in a prior life, I used to manage a lot of data, kind of an analyst. And so when you're just pounding through this stuff, you can see those differentiations or the spread, right, between the 21% and the zero. So I know you guys, with some of your strategies, will allocate out to different providers. So you have a keen insight as to who's really driving the outperformance and who's maybe holding it back or not contributing is what I hear from that, if that sounds consistent with how you're seeing it. But that's great.
Yeah, and I think that when you start to look at the makeup of these funds that are in the index, you notice a few things. There's a subset that are what I'll call single manager type solutions, where it's one private equity GP and you're getting access to a portion of their deals and their portfolio companies. And those often are largely kind of very scaled kind of brand name private equity managers, some of them publicly traded, that individuals are somewhat familiar with, at least from a brand standpoint. There tends to be challenges there in terms of when you're scaling these funds and you're bringing in capital on a regular basis. There's only so many deals that one firm can originate. So that can lead to deployment challenges when you've got money coming in, but there might not be enough in deal flow volume to effectively deploy it on a consistent basis. That's why we advocate more of an open architecture multi-manager approach. We think that delivers better odds of long-term success, because if you have the opportunity to invest alongside, dozens potentially of different private equity firms with different strategies and focus areas and ways that you can transact with them, it just widens your funnel quite a bit and allows you to deploy more capital more consistently. So that's one distinction we see is kind of the bifurcation of single manager strategies versus multi-manager. Other trends that we've noticed is that some funds are very broad in terms of their mandate and their flexibility in their approach. Others tend to focus on more narrow segments of the market. Some of the funds in the index are, for example, focused only on secondaries, or in some cases focused only on late stage, venture type companies that are sort of pre-IPO candidates. And so those kind of more narrow focuses, they might work really well in certain environments, but it might lead to just more variability in outcomes over time, because you're kind of betting on one style or one method of transacting. The open architecture approach, by contrast, you can invest with a lot of different managers, and that can be, again, private equity is a very big ecosystem. It's not a monolith. There's traditional buyout type deals, and even within buyouts, there's large deals, mid-sized deals, small-sized deals, et cetera. There's growth equity. There's venture capital. So you have a variety of different asset classes, and you also have a variety of different ways you can transact with these GPs. You can invest in their primary funds. You can purchase funds in the secondary market, which has certain other benefits that come with it, or you can invest directly in companies through what are called co-investments, which can help from a fee efficiency standpoint, because co-investments tend to have either no fees or significantly reduced fees associated with them. And so a number of different ways that funds have approached these evergreen structures, but in our view, the wider the breadth of sourcing and diversification, the more confidence that you can potentially have in kind of capturing the asset class return.
You mentioned in your notes that the evergreen flywheel. Can you explain, I guess, what that means for listeners? Or
Yeah, I assume most listeners are familiar with the concept of a flywheel in a business context, which is sort of this notion that a series of like interconnected activities kind of build momentum over time and can potentially reinforce one another, creating this sort of flywheel effect. We think that can be achievable as well in evergreen funds in general, in particular private equity. And the way we think about this flywheel, and we have sort of a visual that we kind of built to illustrate it, which is kind of three components. One is that what I just spoke about, which is this open architecture model, which again kind of allows for more consistent deployment, more flexibility, broader sourcing. The other component of this flywheel is the investor experience. We talked about this a bit earlier in the discussion, which is just the more simplified, reporting and ease of transaction just makes for a more pleasant investor experience, the more quicker compounding of capital. We think if you can deliver well on performance through this open architecture model and create an investor experience that's just elegant and pleasant in its design, ultimately that should lead to the third leg of this flywheel, which is scalable capital. In other words, if you're hitting on those other two pillars, in all likelihood, you're going to be raising more funds because you're providing something of value to the market, and more folks are going to want to participate in that. And so that scalable capital side of things, in our view, ultimately leads to better deal flow or enhanced deal flow, maybe more attractive terms with our investment partners as we have more scale, better ability to attract and retain top tier talent. And so we think over time, those three elements can really enforce one another. And if you can execute well on that flywheel, it can really lead to strong results.
That's great. I mean, I love that you guys have such a detailed. It's obviously a very complicated process, but it's all about process. That's what I try and emphasize for the folks I work with. Just I call it the objective, unemotional, rules-based process. We follow this process all the time. They may not know all the details of it, but there's a pretty diligent process that's been developed over a long time. And so to say we're not going to follow it is akin to having no process at all. I just hear a lot of process inside that you're doing with expertise. So I did want to ask, this is kind of off of our, not per se what we plan to talk about, but we are such, to my mind, at a very unique point in history, right? With very high valuations in public markets, an extremely concentrated market, right? With maybe 7 stocks driving all the outperformance, on the cusp of all this AI, data center, massive spend. How does that translate to the private markets? Do you have a sense of that? Are there more opportunities? Are they subject to the same forces? How that's going? Are the valuations better? Is it unprecedented and we don't know yet? Or I didn't mean to ask you a tough question, but do you have a sense of that or not so much?
Yeah, I think I would describe it in that there are, this seems to be one of those technological trends that only comes along, once every few decades or so. And so massive opportunity, a lot of capital flowing towards, anything AI and kind of AI related. You can make a case that we've sort of seen this movie before, and what happens when you have this big innovation is that a lot of capital, comes in, prices go up, forward-looking returns, tend to not be so great following those kind of periods. I'll try not to use the word bubble, but you start to see a lot of maybe inefficient uses of capital when you've got these really kind of hyped up technological breakthroughs and people see all the potential. And so, certainly easier, I think in our view, for prices to get really out of whack with fundamentals, easier for that to take place in the public markets where there's just more trading volume and more, investor exuberance or what have you. I think there are, certainly we're seeing this trend that's been happening well before AI, which is just that companies are staying private longer for many reasons. There's more liquidity options for them in the private equity secondaries market. They don't necessarily want to deal with the short-term focus of quarterly earnings reports, et cetera. So companies, the scale of some of the private companies out there today are just massive, that 10, 20 years ago otherwise would have been, very large, public companies would have IPO'd years ago. And, I think I was reading something earlier, which is, if you just took the three, largest, late stage kind of private venture-backed companies today, and they all IPO'd, that would add like over $1 trillion of market cap to the S&P, which is pretty wild to think of. And so what I think will ultimately happen is like any big trend, you're going to have winners, a handful of winners and a handful of, and I would say many, many more losers, probably kind of winner take most type outcomes, which we tend to see at times. My crystal ball is as cloudy as yours might be in terms of who those winners might be, but I would venture to guess that there'll be some public market winners and some private market winners. I think importantly, that private opportunity set is becoming increasingly accessible to the average investor, where private equity and venture capital have just been these tremendous sources historically of capital formation and economic, contribution, to be able to then obtain exposure to a broad swath of those in a portfolio in a relatively straightforward fashion is, I think, a really great innovation for the investor class, and something that will continue to help augment and kind of broaden the scope of what investor portfolios look like.
That's great. I mean, it's a complicated area, but conversations like this and your work, I think, really help explain it or help people understand it better. As we sort of start to wrap up a little bit, anything else you want to share, maybe the road ahead or just wrapping up, or any other key thoughts you want to share out of the work you've done recently?
Yeah, I think in terms of we follow a lot of what's happening in the evergreen space broadly, because it's not just private equity, it's private debt, it's real estate, it's infrastructure, it's all kinds of alternative investments. We talked a lot about private equity specifically today. If we kind of broaden the scope a bit and look at all evergreen fund AUM today, that's about 450 billion based on our estimates, several hundred funds out there. What I think that's providing, that's a very different landscape than when I first got into the business. And what it's transforming, quite a bit, and I'm sure you're seeing this in your practice, is that maybe private markets were something that advisors entertain for a small subset of their broader client base, depending on their investable asset level or tolerance for illiquidity or any number of variables. I think what's changing now is it's kind of moving from a satellite type exposure for a handful to something that's becoming really kind of core components of how advisors manage their portfolios. So kind of from more niche to kind of mainstream. And we think that'll certainly continue. And with that will be increased innovation and better fees, ideally for investors over time. But I think this what these evergreen structures have allowed for is just more scalable and consistent deployment in client portfolios, as opposed to more episodically, which again I think just can be helpful from a portfolio construction standpoint, and hopefully for investor outcomes, which is ultimately the most important thing.
Yeah, I absolutely see it, and I think you're right. Thus far, I think it is helping investor outcomes and the exposure and the democratization. So I really appreciate you coming on to help explain this. This is your third visit here, so we got to have you back with more to share down the line.
I'd love to. I gotta break the record for most appearances.
I know. You'll have a little bit of an arm wrestling match from with one of the other fellows who's kind of become a sidekick for commentary, more on public stuff, by the way. So you could be my
there we go,
private market guru here. But super appreciate it, Phil. This is great, and thanks for sharing. And everyone, thanks for listening. Please share this. Let me know if you have questions. Always happy to answer. We're going to continue to try and find great guests, and Phil is one of them, and just very grateful I know him, and he's part of my network, and get to share his wealth and his firm and what they, the insights that they have as this situation evolves, and we try and allocate people and get successful outcomes for investors. So thanks everyone for being here. Thank you, Phil. Make it a great day, everyone. Thank you. Bye now.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.